You can reduce the number of units of energy that you use or the number of kilowatt hours, or you can reduce the price that you're paying per unit or per kilowatt hour. So, that combination of reducing price and reducing quantity is going to create value.
Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. Now, if you're enjoying this show, do me a quick little favor and leave us that rating and review. If you haven't done so already, make sure you hit that subscribe button so you don't miss an episode. We've got a great show today. We're going to be talking to Jason Schwartzberg. Now, Jason Schwartzberg is a leading energy entrepreneur and a pioneer in energy cost reduction for commercial property owners. He co-founded MD Energy Advisors after identifying the need for an energy company that can help the real estate community reduce energy spend to maximize profitability. Let's welcome to the show, Jason Schwartzberg.
Hey, John, thanks for having me today.
Absolutely. Jason, I went over your bio at a very high level. Why don't you take 2 minutes and give us a little bit more context on your background?
Sure. So I think it's best to take it from entering the career world. So I did acquisition and development financing for 5 years. I did private real estate for 5 years, and we've had an energy company for 13. So we have a unique value proposition. We understand the real estate owner, we understand finance, and we understand energy. Our core focus is reducing operating expenses and increasing NOI for commercial real estate owners. And at the MD Energy Advisors level, we have 3 concerted focuses. We have a commercial solutions team that brokers electricity and natural gas and does energy efficiency and solar projects. That's really the core or the legacy business. We have a utility solutions team that staffs engineers and business development professionals to the utility rebate programs throughout the country. So we have contracts in New Orleans, Georgia, South Carolina, DC, Maryland, New York, New Jersey. And then we have the financial solutions team that focuses on some energy efficiency financing and C-PACE financing. And that's the team. We have about 50 employees. We started in 2010, bootstrapped the company with 2 business partners and $10,000. So no outside investors, no debt. We retain 100% control of the company today.
All right. Appreciate that, Jason. How did you get into the space, man? You mentioned having a background, a little bit of, doing some private real estate and being in finance a little bit, but how did you kind of morph into this area?
Yeah, appreciate the question. So I wanted to be you, man. Like I wanted to be a commercial real estate investor. So I did the acquisition development financing for 5 years, did some private real estate, and ultimately wanted to own my own company. I thought it was going to be in real estate. As you and your listeners know, requires a bunch of capital and patient capital. And at the time how old was I? It was 2010. So I was about 29, 28, 29. I didn't have a pile of money sitting around. So I was looking at a whole bunch of different businesses to figure out a way to produce cash flow so I could ultimately invest in real estate. And I looked at a bunch of business models. At the time, I wanted it to be scalable, limited inventory, and allow me to work from anywhere were the 3 buckets I was looking to fill. And ultimately, I read an article, energy deregulation was new-ish, and I thought it could check a bunch of those boxes. So that's how we got into the space. And we wrote the business plan in February of 10. We were licensed, bonded, insured by the Public Service Commission in the state of Maryland by April. So we were running pretty hard. And we went for it. We built it on nights and weekends, kept our full-time jobs. And at the end of 2012, it was sustainable. And we went for it. And fortunately, we've been growing the company ever since. Interesting, right before COVID, we were 11 people. And now April of 2023, we are 50 people. So have hit our stride pretty nicely.
I love it, man. Congratulations on that growth over that time frame. And I love you mentioning that it was sustainable-ish, when you made that transition and kind of took that leap to grow this business. So for many investors, they're familiar with very traditional ways of investing in real estate, right? go out there, you secure a loan, probably a commercial loan for a larger multifamily, you come up with some equity, you manage the deal overall, right? When you start talking about energy and you mentioned natural gas and electricity, that's a whole other component. For most investors, they probably just see gas and electricity as an expense line item. Talk to us about, maybe some of the landscape and ways to rethink or reimagine utilities and kind of this landscape when it comes to energy for investors.
Sure. So, look, if you're a full service office building and you reduce net operating income or reduce operating expenses, increase NOI, you can put a cap rate on that, and that's value creation. Multifamily, there's a lot of legacy projects that aren't individually metered. They still have master meter where, sometimes the landlords are billing back, sometimes they're not billing back. But if we pull back at the 50,000 foot, if we're reducing operating expenses, we're creating value. And you can reduce operating expenses from a bunch of different ways. It happens to be that energy is often an overlooked way to reduce operating expenses. And there's two opportunities to do it. You can reduce the number of units of energy that you use, or the number of kilowatt hours, or you can, so we call that quantity, or you can reduce the price that you're paying per unit or per kilowatt hour. So, that combination of reducing price and reducing quantity is going to create value. And you can reduce price by brokering electricity and natural gas, looking at some sophisticated purchasing strategies. There's some ways that you can reduce price. And on the quantity side, it's really, so price is brokering and quantity is energy efficiency. So you can tighten up your building envelope and leverage some of the rebate programs that are out there in order to do it. You can replace an old boiler in your building and get some significant savings. Solar is very interesting, especially for investors that have tax appetite. You pay for the solar system, you have a 30% investment tax credit you can leverage if you have tax appetite. And in theory, at a certain point, you could have free power on your roof once you've paid back that solar system. So energy is an often overlooked opportunity to reduce operating expenses and increase net operating income in commercial real estate.
Yeah, you just talked about a couple really interesting things, right? You mentioned one, looking to reduce your operating expenses, and that is either going to come from, reducing the amount of hours or the amount of units that you use, or the kilowatts, or the price, and actually paying a lower price per kilowatts to save on that. Also maybe taking out old boilers and replacing that with new, higher efficient units. Maybe looking at solar systems or solar panels to put into a property where you can save. When you think about, reducing the cost and the price there, I guess most investors will assume that you're locked into your current provider, right? I mean, am I able to call ComEd or People's Gas and say, hey, you know what? I don't want to pay this anymore. I want to negotiate. Like, talk to us about kind of the brokering and from a conceptual standpoint, like how does that actually work? Can I, as an owner, pick up the phone and call my heat provider, my gas provider, my electric provider, and tell them I want to challenge them or pay something different? Like, how does that work?
Yeah. So there's 13 states around the country that are deregulated. So similar to phone, cable, internet, there's multiple service providers that you can choose. The power is still delivered on the poles and wires, and the utility is still responsible for delivering that power. So ComEd in the example that you raised, but you can actually purchase your kilowatt hours from a different provider. And these aren't John and Jason's electric company, right? Like, these are Fortune 500 companies. Exelon has a competitive purchasing outfit called Constellation that's in this business. Berkshire Hathaway owns Mid-American, which is a competitive energy supplier. So just like people can competitively shop for their cell phone, competitively shop for their internet, they're in these 13 deregulated markets around the country. There's competitive energy options as well. And there's traditionally three reasons why you would look to another provider. Cost, right? Can we out of the gate lower cost? Purchasing strategy. The local utility is going to reprice monthly, quarterly, or semi-annually, depending upon their business plan and the meter type you are. So Again, I think the right down the middle example is a full service office building. You have a full service office building, you're responsible as the landlord for all of the overhead. If you have a 5-year lease and you sign a 5-year energy contract, you can lock in, that energy overhead without having peaks and valleys, and know, as long as your tenant's paying you, know what your profit margin's going to be. So oftentimes competitive energy suppliers can, go out longer and fix you for a longer period of time than the default utility. And the other option is, if you want a layered purchasing strategy, you can dollar cost average, so to speak, in the energy landscape, just like you would in the stock market. So people, and I guess you can also purchase green options. So the utility doesn't always have a green option, but the competitive energy suppliers can, provide a green power option if that's something that you might be interested in.
So on average, or what's typical as far as savings that investors can secure if they were to go out there and look for a different provider to help them save on some of these costs?
Yeah, it's really hard. I mean, every market is different. Every utility in every market is different. I'd say the primary driver is budget certainty. Um, so we likely will be able to save you money, but I think it's very market dependent at the macro, and very market dependent at the micro. Are you in Chicago? Are you in DC? Where might you be? I'd say the number one reason that our investors competitively buy power is for that budget certainty. But we have, historically saved them a substantial amount of money. I think, my other business partner is intimately involved with. So I have two business partners. Myself, I run financial solutions. One of them runs commercial solutions. One of them runs utility solutions. If you would have asked me, 5 or 6 years ago, I could have told you to, the penny as to, where energy was currently trading. But fortunately, we have a team now that does that. But I would say historically, it's, reducing costs anywhere from, just say 10 to 20%. But importantly, having that long-term budget certainty. I think that's really important. Any of your listeners who, got whipped up in the polar vortex, or any of the stuff that happened this winter with natural gas, I mean, you could be going, paying 30, 40 cents a kilowatt hour in some of these markets, which will totally change your budget, versus if you had a fixed rate contract at 10 cents, you know what you're paying, regardless of what the market conditions are doing.
You mentioned that the certainty is one of the biggest values that you get, right? So you kind of know what you're paying. You have a contract. It's not fluctuating and changing all the time, right? The alternative that you were alluding to is that some people, they bill back their tenants, right? They implement a RUB system, or they have a flat billing fee. Maybe they're charging $50 per unit per month for utilities or certain utilities. Talk to us about kind of maybe how this compares to that. So if you have an apartment community right now, you're charging either a flat fee to tenants, or you're implementing RUBs. What could you save, or what are the pros and cons from switching from that model to maybe, working with a company or a firm like yours?
I think it's complementary. So I think if I'm a landlord, or the tenant for that matter, $50 a month an allowance, if you're fixing in your energy costs, what that cost is going to be, versus, some months you might be in the money, some months you might be out of the money. Similarly, I mean, for the tenants with the RUB structure, they have certainty, right? Like, they know what their bill backs are going to be. There was real pain in some of these markets. If you're an apartment tenant and you're used to paying the $50 a month, you could get a $150 bill or $200 bill if, you're in the Northeast in the dead of winter, and natural gas. I mean, you've seen some of the charts; it just exploded. So I think that's even more reason to have certainty as part of your purchasing strategy. So it's predictable for you as the owner, and predictable for the tenant. Especially, the apartment leases are 12, for the most part, 12 months. So you can lock in a 5-year contract, but you could also lock in a 12-month, 18-month energy contract if you have predictable churn, and almost reset your allowances based on your costs, for commodity. If the commodity is going to go up 10%, maybe you change the allowance per tenant, or do some sort of adjustment to your, I would say, your cost of goods sold or your rent number in real time.
I think it makes a lot of sense, right? Because at the end of the day, as investors, we're trying to project both our expenses and our income. And the more stable those figures are, the easier it's
Mhm,
going to be to project.
mhm,
If your utilities shoot up in 1 month, it's going to be $200 per resident. The next month is $40 per resident. That's hard for everybody, right? It's hard for the residents. They're going to have questions. You're going to have to sit there and answer those questions. It's harder to sit there and divvy all that up and justify it. So being able to come in, understand what those costs are going to be, kind of lock in an energy contract where it's flat. It also, protects you a little bit with inflation.
mhm,
As prices are going up, particularly if you're signing a longer term contract, you're signing a
mhm.
5-year contract. That can help you a little bit with inflation kicking in, especially with what we've seen more recently. So makes a lot of sense to at least explore it and see if this is a solution that could help you. Earlier you mentioned C-PACE financing. First of all, what is C-PACE financing?
Sure. So I'm not a big acronym person. So CPACE stands for Commercial Property Assessed Clean Energy. So if you think about your buildings or some of your listeners' buildings, people usually think of energy as solar or renewable projects, which we can finance. But I think the definition is a lot broader than that. It's anything that uses a unit of energy or a unit of water in your building. Um, in markets like Florida, we can finance hurricane related improvements. In some markets out west, we can finance seismic improvements. So I would say it's not narrow, but the narrowest bucket is anything that uses a unit of energy or unit of water in your building, and then it can broaden out from there. And unit of energy, unit of water, you're talking, and we're looking for energy savings or water savings. So if you tighten up your building envelope, you can get energy savings. So we can finance building envelope, we can finance windows, we can finance roof, we can finance HVAC, we can finance plumbing. So a good portion of the capital stack can be financed through the program. I would say the applications are going to be ground up construction, reposition, or energy related capital projects. So if you're doing a ground up construction project, you're going to have to build an envelope. You're going to need a roof. You're going to need, plumbing, HVAC. So good application. If you're going to do a reposition, take an office building to multifamily, you're going to have to do heavy HVAC, heavy plumbing upgrades. We did a deal in Baltimore that it was a value add and needed roof lighting and windows. So that's the portion of the capital stack that we financed. We've also done a lot of energy related capital projects. So elevator modernization, HVAC, you have a legacy asset, you were fortunate enough to lock in your interest rate in 2021, 2022, and you don't want to refi that interest rate in order to make these energy related capital projects. We could, with cash flow, we could potentially finance that project as well. And I can, if it would be helpful, I can continue and unpack the CPACE a little bit, or I'll defer to you on the
Yeah,
questions.
I think let's definitely break that down more. So
Sure.
to recap what you just said, what we're really talking about here, it's the commercial property assessed clean energy and financing. And what it does is it allows you to get funding to make certain improvements. It could be for ground up development, it could be for a repositioning of a project or energy related investments into the asset. And you said like anything that's just a unit of energy. And for those of us who are not in the energy space, that may feel kind of vague and obtuse. So when you say a unit of energy, you mentioned windows, you mentioned roofs, you mentioned plumbing, HVAC systems. So it sounds like maybe everything except for some of the finishes and some of those kind of things this could apply for. And when you said repositioning, you mentioned like maybe converting an office building into multifamily. What about like a more traditional value add, right? So we buy an apartment building, we want to improve the property. Is there a threshold? Is there a certain amount of renovation that needs to happen? Does it need to be the plumbing and HVAC and the roof and all these kind of things? Or hey, if I just want to go in and put $5,000 per unit, can I look at CPACE financing to help with some of those costs?
Yeah, good question. Unfortunately, like we're not for the lipstick deals, right? Like if you're going to do paint, carpet, countertops, appliances, the CPACE isn't going to work, because the premise of the program is, reducing energy, right? So we need energy savings or water savings, and that's why the initiatives that we finance are energy and water, saving initiatives. So, but the deal in Baltimore I referenced earlier was of an existing multifamily transaction that needed CapEx. It happened to be energy related CapEx, and CPACE was really accretive to the capital stack. And it needed new windows, it needed a roof, and it needed new HVAC. If that same deal, they wanted to put in granite countertops and stainless steel appliances and paint and carpet, I can't prove out energy savings or water savings. So unfortunately, we couldn't unlock the capital for that situation. But if
just
you're
for
doing
those portions, so you're saying that for the HVAC, for the windows, for those things, you could provide financing, but for, the countertops, the appliances, those kind of things, that was not included. So that needed a different capital stack to address those issues.
That's right. I mean, and the way that I would look at it is, what is the I'm not going to be helpful to on a value add. I'm not going to be helpful to acquisition, right? Because there's
Right.
no energy related stuff there. And then to your point, paint and carpet, you're probably going to have to rely on your capital provider, your senior lender, or your equity to pay for that. But if there's a good portion of the budget that's energy related CapEx, we can fill that gap in the capital stack. So I think the easiest example is to think of a ground up construction deal, 10 million bucks, right? I used to say you get 70% leverage from your senior lender. I'm not sure you're getting that anymore, right? So say, 60, 65% from your senior lender. And traditionally, the balance of that was filled out through preferred equity, sponsor equity, potentially some mezz, depending upon the structure. Well, where the CPACE can come in, it's a ground up construction deal. You need roof, lighting, HVAC, building envelope, all of that's going to be part of it. So how do we fill a portion of that gap with the CPACE? The value proposition is it's fixed rate, long-term, non-recourse, non-dilutive financing, right? So it's checking all these boxes. It's, you're not giving up. It's cheaper than preferred equity and there's no ownership. It's half the price of mezz and you understand how it functions, right? So you're doing a $10 million deal, and just to make the numbers easy, you're getting 60% leverage from the bank. That takes you to 6. You need to fill that other 4 million of the capital stack. You're probably going to have to put in 10% sponsor equity for the bank to be happy. That takes you up to 7. That other $3 million to take you to 10 is the most expensive part of the capital stack. You're going to do it through pref, where you're going to give up ownership, or you're going to do it through mezz. And we can replace that 3 million, or that $3 million in the capital stack with the CPACE, because in a $10 million deal, you're going to find $3 million worth of plumbing, HVAC, building envelope. It's going to be 10-year plus 400 right now, fixed at closing. So you're, in the mid to high 7s, fixed rate, long-term, anywhere from 20 to 25-year term amortization. Non-recourse, I just need a completion guarantee. I don't need any other recourse once I have completion. So fixed rate, long-term, non-recourse, and I'm non-dilutive. I don't get ownership in your deal. We need 3 things for a successful CPACE execution, outside of it being, ground up construction, reposition, energy related capital project. It needs to be in one of the 30 CPACE eligible markets around the country, growing by the day. We need energy and water related measures to finance. But assuming we've, done that initial qualification on the front end, there's 3 hurdles to a PACE transaction. I need debt service coverage at stabilization, right? So, I mean, we have our senior debt, we have our CPACE. It sits as a special assessment at the property tax level. So it's not a deed of trust. That's the property assessed clean energy portion. So it functions similar to debt. Like, I need cash flow. So I do a financial underwrite. I make sure I have adequate cash flow at stabilization to support the senior loan and the CPACE loan. So that's hurdle number 1. Hurdle number 2 is the technical review side, which is where our 50-person energy company comes in. We have to prove out that the measures that we're financing can save a unit of energy or unit of water. So in many markets, it's prescriptive, right? Like, if you had to do an HVAC of SEER 13 in the market by code to get a building permit, and you did SEER 13 and a half, 100% of the HVAC line items can qualify. So that's, excuse me, that's design. Um, that's all of the piping, electric and everything else, and the actual HVAC equipment itself. So that's hurdle number 2 is the technical review. And then the third hurdle is lender consent, like this from your senior lender. So this sits as a special assessment at the property tax level. So it's collected with the municipality's property taxes. So we need the senior lender to understand that structure. And we have 400 senior lenders who have consented to the CPACE. The reason they can get comfortable is it's a non-accelerating lien. So in our earlier example, where we lent $3 million of CPACE, if for whatever reason the property taxes weren't paid, the only thing that could potentially prime the senior loan is the annual payment on the CPACE. So if the annual payment on the CPACE was $3 million, 7%, a point is 30 grand. So if the annual payment was $200,000 on the $3 million CPACE and it wasn't paid, the only thing that the senior lender would have to cure is that $200,000 annual payment, and they would maintain their lien position. So
Yeah, let me break some of this down, because I think we went
yeah,
into some really good details, but some of it relatively technical as well. So just to recap what you said, right? So the first thing here is that what we're talking about here is CPACE financing, and what this provides is relief in the capital stack to make energy improvements to these properties, right? And the example you gave, if it's a $10 million deal, 6 million may be, coming from the senior lender. You've got maybe 1 million of equity from the sponsorship team, and then there's 3 million that needs to be filled to finish up the development. That 3 million could come from CPACE financing, and that is to address the things we've been talking about: the HVAC systems, the envelope, the plumbing, all of the roof, solar systems, things like that, that really help to drive energy efficiency. And the couple of things that you have to understand are: one, in order to qualify, it has to meet the DSCR levels at stabilization. And what that means is, when you are done building this project or renovating this project, and when it's filled out and it's rented and making money, that the debt service coverage ratio is healthy enough to cover that senior debt, as well as this PACE financing debt as well. I'm not going to call it debt for easy following, but the PACE financing component, right? It's got to be enough cash flow to cover those two things. And I'm assuming it's like maybe 1.25, 1.3. What's your benchmark there?
yeah. So we typically underwrite it to 1.25, but we've done it lower as long as the senior lender can get comfortable and give us that lender consent.
Okay. Okay. So that's important to understand. The second thing is what you just mentioned. You've got to get a lender consent to implement this. Lender has to be on board with that. And then I think the third thing was the technical review. Um, the technical review, what is that? Is that the engineers coming out to the property and taking a look at it? Are they double checking what's the plumbing, the fixtures or whatnot are installed? What does that technical review look like?
Yeah, so good question. It's done on the front end. So we're reviewing your schedule of values, so your construction budget. We're reviewing your permit set of drawings, and we're reviewing your energy forms, ComCheck or whatever they may be, to ensure compliance. So the benefit of, and this is a good kind of pull this together. I did acquisition development financing for 5 years. I did private real estate for 5 years, and you've had an energy company for 13. You need to understand these 3 disciplines in order to unlock this capital. So when we work with our clients, we identify a capital provider and we take them through the process, right? So we have 5 balance sheet lenders that we work with in the space. We will underwrite the deal, financial underwrite, technical review, lender consent, put it together, ride shotgun with our sponsors in order to unlock the capital at the end of the day.
Yeah, I think there's a lot of information here, and obviously we can't get into all the nitty gritty of it. What I heard you say though was, if you are looking to improve the energy efficiency of a product, create something that doesn't exist, right? So ground up development obviously doesn't exist. Repositioning an existing asset, or looking to make some energy related improvements, the CPACE financing could be a valuable tool that helps you with your capital stack. And you mentioned that current rates are somewhere in the 7% range, typically the 10-year plus 400, non-recourse loan, fixed. longer term? When you say longer term, are these 10-year loans, or what's the typical time frame?
Yeah, so it's driven by the municipality, and it's going to be anywhere from 20 to 30 years.
20 to 30 year loans. So that's the
Mhm.
term is 20, 30 years. And is it amortized over that same time frame?
So we have interest only options if we need it to help us out a little bit to get stabilization. But yes, at a certain point, it is a fully amortizing loan.
And is that assumable as well? If someone were to sell in, say, 3 to 5 years?
Yes.
Okay. So I think it's just really important to know, right? Like you can come in and you can leverage this. And again, it doesn't replace the senior debt. But if the alternative is raising all that capital as equity and having to deliver, 14, 15, 16%, annualized return on that versus maybe having this component where there's not a pref return, there's no equity that's tied to this, you're just paying that 7% interest rate with it. This could be a nice addition to the capital stack for the projects that could use this. And again, it's not necessarily for those light value add deals where you're just going in and maybe changing out the cabinets and the countertops and appliances. But if you are touching the mechanicals, the HVAC system, the plumbing, the electrical, things like that, the roofs, that's where you may want to consider this. Is there anything else an investor should know about C-PACE financing when they're thinking about their projects?
Yeah, I think that was a great recap. I think the other couple of things I would consider in the current market is participation risk, right? So a lot of our sponsors who are doing some of the bigger deals that typically require participation are using the CPACE as the participant. So they're getting that one bank close. If you have that $10 million example, you're working with a community bank and the most they want to hold on their balance sheet is 3 million, they need to go out and find another participant bank to plug that $3 million gap in the capital stack. Our folks, a lot of our sponsors are using us to replace that participant and giving them closing certainty in the current market. So that's just one other thing I think to consider. I think you did a great job though of summarizing. It's a little wonky, right? Like the product's a little wonky, but the value proposition is fantastic. And similar to new markets tax credits, historic tax credits, like once people understand them, they put them in every one of the projects, the projects and capital stacks that we do. We've seen a lot of repeat business in the CPACE space.
Well, there is a lot of complexity. I think that's the reason Advisors is a part of the name of your company. If
Sure.
you want to learn more, you can reach out to Jason at mdenergyadvisors.com. And I would say too, if you have a list, Jason, or if there's something we can put in our show notes, you mentioned that there are 13 states that are deregulated, and then you mentioned there are 30 eligible markets. I think it'd be great for our listeners to be able to find out if their core markets are on that list. So if you have something, we'll make sure we link to that in our show notes as well. Or if there's a resource that's readily available, if you wouldn't mind sharing, that might be very helpful for our listeners.
Yeah, you got it for sure.
Awesome. Let's move on to our round of insights. Jason, give me a failure or an apparent failure that sets you up for later success.
Yeah, this is top of mind. So we started the energy company in 2010, working nights and weekends to 2012. At the time, I also had a job in real estate, and I was supposed to be a partner, and I was going to have a really difficult decision to make: either follow my dream of my own company or be a partner in someone else's company. It was April 17th of 2013. I went into a job that I was supposed to be an equity partner in, still building the energy company. My two business partners had already left previous employers to build the energy company, and I was in a little bit of a precarious situation. Do I, go with my guys who we, bootstrap this thing, or, I'm at an established real estate company. I'm going to be an equity investor, or equity owner rather, equity partner. April 17th, go in and do my thing, 2013, and I get pulled into a room and they say, we got to get, you're getting downsized. So how does this happen? I'm supposed to be an equity partner in this place. So this is when you have the right partners. I told you that the business was sustainable-ish. It wasn't, sustainable. It was sustainable-ish enough to afford the salaries of my two business partners, not a third. I picked up the phone. I said, "Hey, man," one of my partners' name is Phil. I said, "Hey, Phil, I got some news." I said, I was let go today. He said, "This is the best thing that ever happened to you." Like, didn't flinch, didn't say like, "How's this going to impact me?" So long answer to your short question, April 18th, 2013, I started working full time for the company that I founded, and it was the best thing that ever happened to me.
Hey man, I love that story, and I love that you remember the exact date and exactly how it happened. And
Yeah,
sometimes the universe works for us and helps us get in the right direction. So appreciate you sharing that. Give
sure.
me a digital or mobile resource you recommend for your business.
Digital or mobile resource. I'm a big LinkedIn guy. I mean, I think, some people are Twitter people. I'm a LinkedIn guy. I feel like, especially if you're following the right crew, I think you can learn a ton. People publishing meaningful content. I was reading a Morningstar report this morning that I probably wouldn't have found on my own. I'm a big LinkedIn proponent.
Give me the book you've recommended or gifted the most in the last year.
Shoe Dog.
Shoot Dog by Phil Knight. Good book there.
Yeah.
All right. Give me a daily habit that helps you stay focused on your goals.
I walk my dog every morning. I have a 3-year-old, 85-pound English cream golden retriever. He's crazy, but we do the same hike. Fortunately, we back up to a park. It's about 1,000-acre park, and we do the same loop every morning just to kind of get focused and get going. And that's a habit I do every morning.
Give me your number one insight for investing with energy in mind.
Play the long game.
There you go. All right. Listen, you are in Baltimore. So give us your favorite place to grab a bite to eat.
Tame Street Oyster House.
All right. Appreciate that. Well, listen, Jason, you did a great job giving us kind of more information on not just your story and your journey, but how we can use energy as investors. One, help the environment, make a difference, use less energy, be more efficient, but also boost returns, add that stability, that predictability for our energy costs, but also finding ways to boost returns, changing up that capital stack and helping us to see more deals, do more deals, maybe even put some deals on the table that wouldn't have worked with more of a traditional approach. So again, if you're interested in learning more, reach out to Jason and his team at MD Energy Advisors. You can go to mdenergyadvisors.com to learn more about him and their firm. Jason, just want to thank you again for coming on the show today. We look forward to staying in touch, and we hope you have a good one. Take care.
Thank you.